Hey everyone, welcome to Easy Options. My name is Anna. If you've been part of our trading room, you know we focus on generating weekly income by trading the SPX ticker expiring on the same day on Monday, Wednesday, and Friday. We use an option strategy called the credit spread, and I wanted to make this video to explain this in detail. So let's understand what a credit spread is. A credit spread involves selling an option and buying another option at the same expiration date, which is further out of the money. Your maximum profit is equal to the premium earned from selling minus premium paid out for buying. So there are two types of credit spreads. First is the put credit spread, also called the bull put spread. It is just selling a put at one strike price and buying another put at a lower strike price with the same expiration date. You would trade the bull put spread when you expect the stock to rise. Second is the opposite, a call credit spread, also known as the bear call spread. You sell a call at one strike price and buy another call at a higher strike price with the same expiration date. Here, you expect the stock to fall. I will be going over a trade we notified on our Zero DTE Alerts channel. We use the Thinkorswim platform, but there are many reputed brokers, including Tastyworks or Interactive Brokers, which offer options trading. Here, you can see the options chain for SPX. The middle indicates the strike price, and we will look at the left side for call options. We expect the SPX index to move lower, so we have traded a call credit spread. We sold a call at 44.15 and bought a call at 44.20 further out of the money, expiring the same day. The difference between the strike prices is called the width of the spread, and we always chose a 5-point spread, although some members use 10-point wide spreads as well. Let's calculate the net credit received. Selling the 44.15 strike call, we would receive a credit of $3.98, and buying the 44.20 strike call, we would pay $2.58. So the net credit on the call spread would be $1.40. For each contract consisting of 100 shares, the maximum profit is $140. Now we will calculate the max loss. If the SPX rises, then the short call option loses money, and the long call option gains in value. The maximum loss is equal to the difference between the two call strike prices, which is $5, and the net credit received. In this case, for a 5-point wide spread, it will be $500 minus $140, which is $360 per credit spread. And it's a must you understand the margin required to enter a credit spread. You will need a margin of $500 to make a profit of $140 per contract. However, since you always get the premium no matter what happens, your net effective risk is $360. This trade has a high probability of success. As we saw on Thinkorswim, the probability of this trade expiring worthless was 90%, which means you get to walk away with max profit if SPX stays at the same level, goes down, or even goes up a little. This strategy works well because along with having a high success rate, it has a good return on investment. In this case, we will receive $140 for $500 investment, and that is 28% ROI per Zero DTE trade. This ROI will compound and grow bigger as you repeat the strategy. Let's look at the chart. We entered the call credit spread 15 minutes after the market opened. We are mildly bearish on SPX, and to receive max profit, SPX needs to close below 44.15 price. That was simple, right? Next, as long as SPX is trading below the break-even price, we will still be profitable. Break-even price for a call credit spread is the short call strike price plus credit received. So, for this example, the break-even price would be 44.15 plus 1.40, that is 44.16.40. And if SPX rises above the break-even price, then we need to figure out a way to close or adjust the position. We analyze signals and watch resistance and pivot levels throughout the day. We would also decide to close the position if the premium to be paid reaches 2 to 3 times the credit received. To summarize, we send an alert in the first 20 to 30 minutes after the open to capture morning volatility and help our members receive higher premium fills. I think it's very important for me to be transparent with you and let you know that although this strategy has a high success rate, if you let it go to max loss, then it can wipe a considerable number of prior gains. The key to this is to start small, start with smaller contract size, get comfortable with the strategy before you scale the number of contracts. Learn to master the art of emotionless trading. Speaking from experience, this is a skill you will learn only by trading often and consistently. It is very easy to get stressed and make the wrong decision by not cutting your losses and not sizing your contracts optimally. It's really critical to maintain a trading journal to evaluate the results of this strategy over time. And remember, gains compound over time. If you've been trading this strategy for 2021, you would have had a return of over 78% just to date. If you've invested $5,000, you would have earned a profit of $4,000 in gains. At Easy Options, we want our members to be consistent winners. If you have any questions, please feel free to ask me. Thanks for watching, see you soon, and happy trading!